Okay, let's unpack this. We've got the 2024 Form 10K annual report for, well, a certain major entertainment company.
Right.
Think of it like getting the detailed blueprint and maybe the health report for a massive, complex machine. This deep dive is tailored just for you, pulling out the most important insights, but strictly from the details they shared in this report.
Yeah, and this isn't just some, dry filing. This document gives us a really thorough look under the hood. It shows the financial realities behind those brand names we all recognize.
Exactly. So our focus today is understanding their different business segments, how the money flowed this past fiscal year, what they're doing for the shareholders, the owners, and what the path ahead looks like.
But based only on what's actually written down in this official filing. That's key.
Absolutely.
Our mission here really is to help you quickly grasp the essential information from what is, let's face it, a pretty complex document.
We'll distill the key takeaways, those aha moments, and sort of connect the dots for you.
Yeah, save you reading the whole thing yourself.
So let's jump right in. Let's unpack the business segments.
Yeah.
This company operates across three main areas: entertainment, sports, and experiences.
And understanding these segments is absolutely key. It's how you understand the overall business, how they actually make their money.
Right.
So the entertainment segment, that's probably the one with the most moving parts. The report breaks it down into three main components: linear networks, direct-to-consumer or DTC, and content sales licensing.
Okay, linear networks, that's the traditional television side, yeah, like cable channels.
Precisely. This is where the revenue primarily comes from, things like affiliate fees, what cable providers pay them, and of course, advertising sales. The report gives examples like FX, National Geographic, Disney Channel, those international star channels.
Okay.
And they also have that equity investment in A+C networks, which includes, A&E, History, Lifetime. And the report actually gives us some interesting numbers on subscriber estimates there.
Oh, yeah. Like, what does the report say about the scale of these networks now?
Well, based on their internal estimates, this is as of September 2024, they're looking at around 240 million unique subscribers globally for their general entertainment channels.
Wow.
And roughly 200 million for the family channels. For that A+E part in the U.S., based on Nielsen data from around the same time, A&E, History, and Lifetime each have an estimated 58 million subscribers. That includes traditional and most digital services.
That's still a huge reach, even, as the whole landscape shifts.
Definitely.
And the report clearly calls out the challenges, right? Like increased competition and the constant renegotiating of those carriage agreements with distributors.
Oh, yeah. They are definitely highlighted as risks, which naturally leads us to DTC, the streaming world.
Right. The big one everyone talks about. Disney Plus Art, Hulu, ESPN Plus Art.
Correct. Subscription-based services mainly. Revenue comes from those subscription fees and increasingly from advertising, especially since they rolled out the ad-supported tiers.
Right. And the 10K gets pretty specific, doesn't it? About subscriber numbers and, importantly, that average monthly revenue per paid subscriber, the ARPU for each service. What stands out there?
Well, this is where you see some really big differences. As of late September 2024, domestic Disney Plus had 56 million subs, averaging $7.89 a month.
Okay.
International Disney Plus, but excluding Hotstar, had 66.7 million, averaging $6.60.
That's still pretty close.
But then Disney Plus Hotstar, which is mostly India, had 35.8 million subscribers, averaging just $0.96. 96 cents.
Wow, less than $1 average revenue. That's really striking.
It is. And then you've got Hulu SVOD, only at 40.8 million, averaging $12.35. And Hulu Live TV plus SVOD, much smaller at 4.5 million subs, but their average revenue was way up at $95.12. Obviously, a very different service.
$95. Okay, so that Hotstar number. Does the report explain why those averages vary so much? Is it just market differences?
It points to a few things. Higher retail pricing helped boost the averages for domestic and international Disney Plus. And Hulu, they did raise prices, remember? But it also notes offsets. Like for Hotstar, there's a higher mix of subscribers in lower-priced markets. And elsewhere, you have things like promotional offers, wholesale deals, and advertising revenue contribution also plays a role. It's noted as being higher for Hotstar, but actually lower for that really expensive Hulu Live TV tier.
Okay, so pricing strategy, the mix of markets, ad revenue, it's a whole combination.
Exactly.
And the risks for DTC must be intense. competition, obviously, but also the huge cost of content
Yeah.
and just keeping subscribers from leaving churn.
All explicitly listed. Key challenges, according to the report. Then finally, under entertainment, you have content sales licensing.
Right. This is basically selling their movies and shows to others or licensing characters, stories, that sort of thing.
You got it. Licensing content for TV or other streaming platforms, theatrical distribution, movie, releases home entertainment, music, stage plays, merchandise. It's a mix.
Yeah.
And theatrical results, that can be a big swing factor year to year. Really depends on the timing and, well, the box office success of their films. The report notes they expect to release about 15 films in fiscal 2025.
15. Okay. Now, here's where it gets really interesting, I think, and tells a key part of this year's story. The report highlights a pretty significant shift in the entertainment segment's overall financial performance in fiscal 24 compared to 23.
Absolutely. A massive improvement in operating income for this segment. We're talking an increase of over 100% in fiscal 2024.
Over 100%. What drove that?
The report pins it primarily on two big things. One, a significantly lower operating loss in the DTC business. Streaming lost a lot less money.
That's huge.
Huge. And two, improved results in content sales licensing, largely thanks to better theatrical performance.
Yeah.
Remember, they took some big content write-downs the previous year, so the comparison looks good, but the theatrical rebound helped. That move towards streaming profitability is a major, major driver here.
Okay, that makes sense. Let's move to the sports segment then. This is primarily ESPN, right?
Primarily. ESPN, both domestic and international, plus Star India. Revenue sources are similar. Affiliate fees, advertising, and subscription fees, particularly for ESPN Plus.
And ESPN Plus is where you find a lot of that live sports content, including the report notes big events like UFC pay-per-view.
It is, yeah. As of late September 2024, ESPN Plus had about 26 million paid subscribers. And the traditional ESPN channels, they still have a massive footprint in the U.S. ESPN and ESPN2 were each estimated around 66 million subscribers.
Still big numbers.
Yeah.
So how did the sports segment do financially overall in fiscal 2024?
Well, the segment operating income actually saw a slight dip overall, down 2%.
Oh, okay. Why was that?
The report clarifies this was due to increased losses at Star India. Those losses more than offset the improved results they saw at ESPN Domestic.
Oh.
They actually break out the operating income numbers separately. ESPN Domestic brought in a strong $3.0 billion, but Star India had an operating loss of $636 million.
Okay, so domestic ESPN is still a major profit engine, clearly. But Star India is currently a significant drag on that segment's bottom line.
That's what the report indicates.
And I assume the report highlights the intense competition for sports rights and ad dollars as key risks here, too.
Definitely. They emphasize that competitive landscape, the ongoing challenges in securing and renewing those really high-cost sports rights, and also the carriage agreements for the channels themselves.
Makes sense. Okay, finally, let's dig into the experiences segment. This sounds like everything physical. The parks, the resorts, cruises maybe.
It is primarily parks and resorts, yeah.
Ugh.
This covers the theme parks and resorts globally. You know, Walt Disney World, Disneyland, Disneyland Paris, Hong Kong, Shanghai.
Right.
They also license their IP, their intellectual property, for Tokyo Disney Resort. And then it also includes consumer products, which is primarily merchandise licensing royalties.
So revenue sources are things like park tickets, food, merch, hotel stays, vacation packages, and those licensing royalties.
Exactly. And the report gives us metrics like per capita guest spending, attendance levels, hotel occupancy, per room guest spending, things like that to show the trends.
And how did this segment do?
They reported that this segment's operating income increased by 4% in fiscal 2024.
Okay, decent growth.
Yeah, and the report states this was mainly driven by strong performance at the domestic parks and experiences, higher guest spending and increased volumes, so more people spending more money.
Good combination.
But it was partially offset by higher costs and also unfavorable foreign exchange impacts internationally. So the U.S. parks really carried the growth.
It totally makes sense that this business is tied so directly to travel, tourism, the wider economy. Does the report call out risks related to things like, I don't know, weather, economic downturns, global political stuff impacting travel?
Yes, they are explicitly mentioned as potential impacts on this segment. Uncontrollable events, economic conditions, they're all listed risks.
Okay, that gives us a really great picture of the three main businesses and, their performance trends according to this filing. Now let's zoom out. Let's look at the consolidated financials, the whole company. What were the big headline numbers for fiscal 2024 compared to 2023?
Okay, top line. Total revenues increased by 3%, reached $91.4 billion in 2024, up from $88.9 billion in 2023.
Okay, 3% growth. Not huge, but growth.
But you see a much larger jump when you look at the bottom line. Net income attributable to the company, it more than doubled. Went from $2.4 billion in 2023 to a strong $5.0 billion in 2024.
Wow, okay, that's a significant jump. And diluted EPS, earnings per share, presumably followed suit.
It did, jumped to $2.72 in 2024 from $1.29 in 2023. And as we kind of touched on earlier, the report attributes this big increase primarily to that much higher operating income in the entertainment segment, driven by those improved results in DTC and content sales.
So entertainment, especially getting DTC losses down, was the main engine for that profit surge.
According to the report, yes.
What about the cash flow story? For a lot of investors, how much actual cash a company is generating is just as important, maybe more important than accounting profit.
Right, and this is actually a really positive story in the report. Net cash provided by operating activities saw a substantial increase, rose to $12.0 billion in 2024.
$12 billion. How does that compare?
Well, it's up from $9.9 billion in 2023 and way up from just $4.3 billion back in 2022.
Okay, that's a huge jump over 2 years. A really strong trend.
Definitely.
And they spend a lot on building things, right?
Yeah.
Especially in the parks. Capital expenditures, CapEx.
Capital expenditures were $5.4 billion in 2024, primarily, as you said, invested in parks, resorts, and other property.
Okay, so if we take that operating cash flow, the $12 billion, and subtract the CapEx, the $5.4 billion,
Right.
what's left? That sort of free cash flow proxy.
Right, the cash generated from operations after investing in these assets. The report shows that number is approximately $6.6 billion in 2024.
$6.6 billion. How does that compare?
That's a significant improvement from around $4.9 billion in 2023. And it's particularly strong compared to a negative figure they had back in 2022.
Negative in 22. Wow.
So it clearly indicates the business is now generating substantial cash after funding its core investments and operations. That's a really key financial takeaway from this report.
Absolutely. That's a turnaround.
Yeah.
Just a quick look at their debt levels. Anything stand out?
Total borrowings were $45.8 billion at the end of 2024. The report does note they comfortably met their key debt covenant, which relates to interest coverage.
Okay.
And they had substantial unused bank facilities. So from the perspective of the report, that indicates good financial flexibility. Net interest expense, however, did increase during the year.
Right. Rates were up.
Right.
And the effective income tax rate dropped, you mentioned.
It did, yeah. To 23.7% in 2024 from 28.9% in 2023. The report explains this was partly due to a benefit from some prior year's tax matters and also a lower foreign tax rate. That was despite having significant non-tax deductible charges during the year.
Non-tax deductible charges.
Okay.
You mentioned goodwill impairment earlier, right? Tied to those entertainment linear networks. Can we circle back on that? What exactly does that mean?
Yeah, absolutely. It's an important point in the report. They recorded non-cash goodwill impairment charges totaling $1.3 billion in fiscal 2024 related specifically to those linear networks. That followed a $0.7 billion charge for the same thing in fiscal 2023.
Okay, billion-dollar write-downs. But what is goodwill and why impair it?
So goodwill is basically an intangible asset. It represents the premium a company pays when it acquires another company or assets, the value attributed to things that aren't physical, like brand reputation, customer lists, expected synergies, that sort of thing.
Right.
Impairment means they had to reduce the value they carry on their books for that premium. Why? Because the future prospects, or the expected future cash flows from those assets in this case, the linear networks are now estimated to be lower than they originally thought when they recorded the goodwill.
So they're basically saying the traditional TV business they own isn't worth, on paper, what they once thought it was, forcing them to write down its accounting value.
Precisely. And the report adds a really critical detail here. It states that after these latest write-downs, the estimated fair value of the aggregated entertainment reporting unit's goodwill is now less than 10% above its carrying amount on the books.
Less than 10% buffer. What does that imply?
It highlights just how sensitive that remaining goodwill value is. Even relatively small negative changes in things like the discount rates they use for valuation or their projections for future cash flows from those linear networks could trigger more impairment charges in the future.
Wow.
It really underscores the significant financial pressure and challenges facing those traditional media assets today, as captured right there in the filing.
That's a stark detail, kind of buried in the financial notes.
Okay.
Let's shift gears then to shareholder value and what the report says about the path forward. Based on this past year's improved performance, what did the company actually do for its shareholders?
Well, a big step noted in the report is that they've reinstated dividends.
Had it stopped for a while, right?
It had. The report points out no dividend was declared for fiscal 2022 operations, but now they declared a cash dividend of 0.30 cents per share for the second half of fiscal 23, which was paid out in January 2024.
Oh.
And importantly, they declared $0.45 per share for the first half of fiscal 2024, paid more recently in July 2024. So dividends are back on the table.
45 cents for the first half of 24.
Okay.
And they also started buying back their own shares.
Yes. Effective February 2024, the board authorized a pretty large repurchase program up to 400 million shares.
Okay.
And in fiscal 2024 itself, they repurchased 28 million shares, spending $3.0 billion on those buybacks.
$3 billion buying back stock.
Yep. And the report states that as of the end of the fiscal year, they had approximately 372 million shares still remaining under that authorization. So plenty of room to buy back more.
And buying back shares, that reduces the total number outstanding, which can potentially boost earnings per share, return value to shareholders.
Exactly. It's another way, alongside dividends, to return capital.
So that strong cash flow we talked about is helping fund both dividends and buybacks now. Makes sense. Looking ahead then, what strategic actions and challenges does the report point to for the future?
Well, connecting this to the bigger picture, the report does acknowledge strategic actions underway, like the planned Star India joint venture we mentioned earlier.
Right, the one losing money.
Yeah. It specifically notes the associated $1.5 billion impairment charge they took in fiscal 2024 as part of setting up that transaction, basically cleaning the slate a bit before the JV.
Okay.
They also provide some guidance on anticipated content spending for fiscal 2025. They're projecting approximately $24 billion.
$24 billion on content. Wow.
It's a huge number. That includes sports rights, but it excludes the content spending for that Star India JV, since that's being spun off. Still, a massive ongoing investment needed to compete.
Absolutely. And the report, I assume, lays out the risks they face moving forward pretty clearly.
Oh, yeah. It reiterates the key risks that could definitely impact future performance. Things like broad economic conditions, obviously, intense competition across all their businesses, particularly noted for DTC streaming and advertising. Protecting their intellectual property is highlighted as a major ongoing focus. They mention challenges like, the copyright expiration for early versions of classic characters, like the early Steamboat, Willie Mickey Mouse getting into public domain.
Right, we heard about that.
And also the risks posed by unauthorized use and emerging technologies like AI potentially scraping or misusing content.
Interesting. What about the regulatory environment? Always complex for a global company like this.
Very much so. The report cites navigating a complex and evolving global regulatory landscape, things related to privacy, data protection, content rules, plus the potential impacts of global events, trade restrictions, things like that.
Lots to manage.
And finally, they also mention efforts in human capital, their workforce, and environmental sustainability as ongoing focus areas for the company, as you'd expect.
Okay, so let's try and sum up this deep dive into the 10K then. It seems the company showed significantly improved profitability and generated really strong cash flow in fiscal 2024.
Yeah, that's the headline.
Largely driven by shrinking those big losses in streaming and a recovery in theatrical releases within entertainment, plus solid performance in their domestic parks.
Right.
And they're actively returning value to shareholders now through reinstated dividends and share buybacks,
Right.
which is fueled by that improved cash generation, all while continuing to make just massive investments in content and experiences globally. But the filing makes it clear they still face some really notable challenges, right? Particularly in those traditional linear networks, evidenced by those billion-dollar goodwill impairments.
Yeah, that's a big flag.
And the international Star India business, which is being restructured, all while navigating just intense competition in a really dynamic global environment.
Exactly. Which, raises an important question for you, the listener, to consider. Given that sensitivity of the entertainment segment's asset values, which the report highlights with that goodwill discussion, And the ongoing undeniable challenges in traditional media, coupled with the intense competition and just the incredibly high costs required to compete in streaming, what do you think will be the single most critical factor for this company to sustain and hopefully improve its financial performance going forward in the face of these, rapidly changing market conditions?
That's a great question. Something to definitely mull over as you digest all these details from their own report.